folks, it's Dave Burrows. I am CEO and CIO here at Barometer Capital Management. And thanks everybody for joining us today. We got lots of folks, I think, on today. I think markets have been confusing for lots of investors, lots of cross currents, certainly lots of news flow. And then in the absence of news flow, a little stronger market, which is nice to see. No shortage of catalysts coming at us. Of course, we got April the 2nd that is looming. People wondering what sort of tariffs might be announced, what sort of reciprocal tariffs might be announced. We've been watching earnings revisions. We've been watching economic data. We've been watching inflation data. And all of these things impact markets. And while it would be really nice to tie things up with a bow and say, this is the piece of news that's important, the fact is we got a lot of moving parts. And all of them are having an impact on price. And ultimately, what we try to do with these webcasts is in going through the thousands of charts that we go through, try to understand the story that the market is telling us to make sure that we stay in tune with what's going on, that we stay positioned in parts of the market that have a tailwind and hopefully avoid some parts of the market that have a headwind. And be a little tactical along the way. So as always, I want to start sort of with a top-down view of the world and what's going on. We'll start with the S&P as an important bellwether. You can see down 3.1% on the month of March. We're trading well above this long-term 200-week moving average, which tends to be the lower bound, even in significant corrections along the way, like 2022, 23, like 2020, like 2018 into 19. We are in a structural bull market as it stands right now. When you look at it, it's been 144 months. The bull market of the 80s and 90s went 217 months. Doesn't mean that it has to be as long, but we certainly don't want to be in one of these periods, the secular bear market. And in those periods, strategy has to be very different. Exposures have to be very different. You got to be a lot more nimble. But when you're in a structural bull market, you have to start by giving the market the benefit of the doubt. When we look at the S&P, S&P has been working its way higher since it made its first new high in January of 24. So now we're in March of 25. And for the first time, we are below the 200-day moving average. So the S&P did bounce a little over the course of this last week. We bounced up underneath the 200-day moving average. We're not through. We are below, the 50-day. We're below the 2 to 21-day, and we're basically below the 200-day. So just from a simple trend following perspective, if you were to look at the market as a whole, market cap weighted index, it's below the long-term trend, the 200-day moving average. It's in correction. The NASDAQ 100 has had probably a bigger pullback, 13.7% top to bottom. And again, we've rallied up underneath the 200-day moving average. We're below the 21-day and below the 50-day. And again, this has been coming really since midway through February. When we look at the Qs, which is dominated by technology, 50% are the big 7 stocks. The NASDAQ 100 relative strength has been lagging since June. So we don't want to try and attach this to what's going on politically because frankly, the underperformance has been going on a while. And these are big important stocks, and the S&P makes up just about 30% of the S&P, the big 7 names. And technology in general has been kind of sloppy. Now, we're in the time of year in a new administration where you tend to have choppiness between day 50 and day sort of 110, 115. And we've certainly had more in this period of time than we have had typically. Well, there's been a lot going on. Things have been moving at light speed. That's created a lot of uncertainty. We looked at the index of policy uncertainty last week, lots of uncertainty. It's interesting that many of Trump's key lieutenants have been out doing long-form interviews on some of the big podcasts, like the All In podcast, where they've had Scott Bessent, they've had Lutnick on. So, they're trying to get their message out as to what it is that they want to do. But, very clearly it's an America first policy, which is not great if you're not in the US. And it creates a lot of question marks around supply chains and inflation and that type of thing. So we know that that the U.S. market is quite expensive. I think this is probably a little bit a little bit of hyperbole, insanely expensive, but it certainly is the U.S. market expensive relative to the rest of the world, and the rest of the world actually been doing pretty well. We've talked a lot about Japan over the last couple of years. We've talked over the last few weeks about the Eurozone breaking out to new highs after basically being in a structural bear market since 2008. We've talked about some of the individual countries like Germany and Italy and Spain making new highs after many years of not making new highs. The point that I want to make here is that when global stocks start to outperform after a long period of underperformance, it tends to go on for a long time. And this is the very, very beginning and likely something that could go on. We've talked about Argentina over the last year. I highlight this partly because in many ways, what the Trump administration is idealizing is what's been done in Argentina over the last 3-4 years under their new administration, cutting significant parts of their federal government, cutting spending, and that led to a rise in unemployment, a fall in GDP growth at first, but then the private sector did take over. And they are seeing sharp growth in the economy. They are seeing growth in employment, and they have seen inflation come down. So, it's a long way between saying and doing, but it's certainly at this point working for the Argentinian stock market. If we look around the world, US is way down the list on returns for the year. Global markets have been a lot stronger. And, over the past week, things pulled back a little bit for global stocks, and US stocks bounced a little bit. But frankly, there's a very clear theme here that we want to keep in mind. And it is that we need to be looking at global stocks because generally, when the flows begin, and we have seen some sizable flows in, it goes on for a while. We've highlighted the fact that global markets tend to have less technology, and we know that technology has been underperforming in the North American markets. And we also noted that cyclical stocks relative to defensive stocks have been outperforming even more so in the US than they have been since the beginning of the year in the US. So it happens to be that global markets are dominated by more economically sensitive sectors. Energy, materials, consumer discretionary, and financials would be big parts of the MSCI All World ex-US index. So China also has been showing some improvement. And when we look around the world, it's a little fuzzy. This is the number of countries that are in very clear uptrends and when they started. So the market has been broadening globally. And has been becoming stronger. And that's a healthy thing. If more markets are participating, that's expanding breadth. That's the same concept we use at the sector level. More and more markets participating means the equity asset class is an important one. We need to keep an eye on it. Okay, so the TSX, interestingly enough, has been acting a lot more like global stocks than US stocks. You can see this is the last 4 months. Actually, we're trading virtually at the highs in the TSX, which would betray some of the feelings that we have about tariffs. And the US stocks have outperformed for a long time. So interestingly, TSX relative to the equally weighted S&P has really been making quite an important turn. This chart goes all the way back to 2008. So Canadian stocks underperformed really until 2021, really 2021 through 24, it's been about even, but they've certainly been picking up over the last number of months. And this month, again, pretty solid outperformance. The same picture for the MSCI All World ex-US index versus the equally weighted S&P. So it looks to me as though the US is no longer the only game in town. That may have something to do with the differences in the sector weights in global stocks versus US stocks. As I said, very little technology and a lot of financials and industrial companies. But it's an important structural change to take note of because, this can go on a while. Now, US dollar has been backing off since the beginning of the year. That means other currencies are rallying. It means that if you're a European investor and you've had a weak currency, your currency is now strengthening and your stock market strengthening. That can build on itself, money repatriating back to Europe. If you're Japanese and your currency is appreciating and your stock market's doing pretty well, that's a self-fulfilling cycle that can cause you to bring money back from the US. That's without talking about some of the political discomfort that investors around the world are feeling about some of the changes that are taking place in the US. So happy to say that the global fund we launched in December of 23 has continued to perform well. It's up about 39% over the period versus the index about 24. It continues to be ranked sort of in the top percentile year to date over the last year and over the last 3 months versus, about 1,000 or 1,100 global funds. And we think it's relatively early days. On yields, we continue to see higher highs and higher lows in yields. And interestingly, even though yields pulled back a little, they started to firm up again over the last couple of weeks. Now, I think it's a really important concept, and I know I've said it over and over again. What works during a long period of falling interest rates is very different than what works in a period of rising rates. And we are in a period of rising rates long term. For the first time in 45 years, when they started cutting rates around the world last fall, long-term bond yields went up, not down. So the curve started to steepen. Investors were demanding a higher rate of return to tie their money up for longer than they would get on short-term money. And that has implications for lots of different industries that require financing. Now, the obvious one that gets hurt during rising rates is the bond market, and the long end of the US bond market has been falling, pretty steadily since 2020. Even this little rally attempt we saw early this year looks to have failed. Over the last week, we're breaking this trend to the downside. We're trading below all the long-term moving averages, and the moving averages are moving lower. But the other thing that gets hurt by rising interest rates is other leveraged investments. And I think that this is an important one just for us to keep in mind because it has an impact on all of us as individuals and families. I think it's interesting when we look at the statistics around US national home price changes from 1891 to 24. Rates started rising in the early 50s. And as rates started to rise, house prices stopped going up in price. If you look at home prices in real returns, in other words, inflation adjusted, look at all the pink. 0, -2, -1, -1, 0, -1, 0, 0, 0, -2, -1, 1, 3, 1, 0, -5, -2, and we're in 1975, 20 years. In that period, zero rate of return for real estate prices in inflation adjusted terms. Now, look at since 1981, a lot of green. 1999, 5, 6, 5, 7, 8, 10, 10 correction through the financial crisis. This is the US, worse than in Canada. 5, 9, 4, 3, 4. So it's really important to recognize these structural changes and the impact that it can have on your financial condition. So when we look at the asset classes, we continue to believe S&P 500 is a better investment than a long-term treasury bond. Equities in general around the world are an inflation-protected asset, and in general, they should outperform bonds consistently. And since rates bottomed in 2020, that's been very steadily the case. And then recently, we pulled back to that moving average and have bounced over the last couple of days. If we look at dividend growth stocks relative to bonds, our case has been for income investors. If we think inflation can be persistent, we would be prefer to focus on dividend growth stocks that will give us a rising stream of income versus bonds, which will give us a fixed rate of income. And again, we held at the moving average, and stocks continue to trend higher relative to bonds. So we think that this is a great inflation protecting asset, which is why we're focused there in our income portfolio. When we look beyond to commodities, boy, this has been really interesting. A first leg higher starting in 2020. We went through the tightening cycle. Look at the last few months. Just tick, 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 tick. This is an index of various commodities across the board in the US. If we look at gold, it's been a leader. It's been in a bull market for 426 days. And this is after a long bear market that started in 2012. So this is a cup with a handle. This is a consolidation and broke out and now in a bull market. So I've had lots of people say, well, gold's now up a lot. So what's next? And I just want to remind everybody that the bull market that happened in the 2000s went on for 1,544 days, was up 370% in 3 distinct waves. We're up 47% in 426 days. The bull market in the 70s and 80s, 1,500% over a very long period of time with some significant rallies along the way. So we think that we're very early days here. Silver looks similar. Silver is basically trading now at the highs. And if we go back over a long period of time, again, it's up about 80% above the moving average. But in the last bull market, got to 350% above the moving average, 1,300% above the moving average. It was up 3,600% in the 70s and 80s. So we're not saying that that's going to repeat, but I would say we've gone through a long bear market, and certainly things have come out of that bear market, and we're headed higher. So precious metals continue to look really interesting. Moving along, copper really appears to be joining this same theme. So this is a chart that goes back to 2020. The pink box, which we can look at in more detail, the bear market went on from 2010 until 2021. And then we came down and tested this level a number of times. But look at this blast off. I think this is really significant. We're now trading at all-time highs. If we go back, copper prices between 2002 and 2009 in the last commodity bull market up 540%. Well, again, this is probably the beginning. So commodity prices are telling us a story. With bond prices underperforming and commodity prices outperforming, it would tell you that investors or marketeers are more interested in inflation-protected assets than disinflation-protected assets. Recently, copper's actually started to outperform gold. So we compare commodities to bonds, commodities are solidly outperforming. The reason we talk about this is because we clearly are in a period of more inflation, and we need to own assets that are relevant in an inflationary environment. So commodities relative to the equally weighted S&P. Actually, commodities now outperforming the equally weighted S&P since 2021, and it looks like we are reaccelerating to the upside. So just important things to keep in mind. Last thing, if we really want to talk about inflation versus disinflation, since rates started to rise and inflation picked up, gold relative to utilities. Utilities are a high dividend paying security with very little growth or inflation protection. Gold is a low yielding asset that does have inflation protection. And again, since November of this year, it looks like we've started another move higher. So no sign that the concern around inflation is waning. Let's talk quickly about Bitcoin, because I've been asked a little bit. This is not a big asset for us, but clearly it's had a number of bull markets along the way. We'll see, but when we compare Bitcoin relative to the S&P, it continues to be in an uptrend, and it looks as though it's held in this recent pullback on a relative basis versus stocks. We'll see whether it can reaccelerate to the upside, but the trend is intact. Last, on the big picture, Canadian dollar, only because we are in a political time here. We've had a lot of political turmoil and obviously concern around tariffs. It is interesting to me that the Canadian dollar has been able to hold at the same level it held at the worst point of the COVID sell-off and at the worst point of the commodities bear market in 2016. So we'll see whether that continues to hold, but at this point, it's looking more likely that the lows are in on the Canadian dollar. Okay, So look, we don't have to be everywhere. Our job is to try and identify pockets of the market that are seeing inflows, to recognize change as it takes place so that we can reposition portfolios and make sure we understand sort of the lay of the land as it is today and make sure the portfolios line up. And we have to play defense from time to time. And we have had a more defensive stance recently because we do have a tactical approach. In a healthy market over time, a larger and larger number or percent of securities should be participating in a rally. That's healthy. And so from a process standpoint, we're big believers that we need to address all of the factors that impact return. We do some top-down work to try and find asset classes and sectors and themes that are seeing net inflows, seeing expanding breadth. And at any given time, there will be some. And then from a bottom-up perspective, we need to find securities to use to express our view. And we're trying to find securities that are good, getting better, where fundamentally we see improvement in the underlying numbers, the income statement, and the balance sheet, and where we see technical price behavior that is positive, that supports that positive fundamental view, and where we can find good getting better fundamentally and good getting better technically in parts of the market that are performing well, that's where our portfolio should live. Now, we've talked recently about what happens in a more difficult market, because when breadth contracts or fewer and fewer securities perform well, it means that we have more risk. And it means that even our good performing securities can wind up being impacted as breadth contracts. When breadth is contracting, we stop putting on new positions, we raise some cash, we tighten up the stop losses we use, and we don't put on new positions. So look, the picture this week is better than it was last week. Breadth in the short-term measures have improved over the course of the week. Depending on which part of the market you look at, breadth in the US is improving. So NYSE, the big market, a little more old economy, showing improving breadth. NASDAQ has a very mixed picture. The breadth data, or the bullish percent for the NASDAQ, is solidly negative. The short-term indicators are very mixed. 2 of 4 short-term indicators have turned up. Not enough to consider putting on positions. Globally, it's also mixed. Europe and Asia look excellent. There are certain markets, India is not as strong, a couple of Latin American countries not as strong, but in general, breadth is pretty good on a global basis, and percent of stocks above the 50-day continues to expand. Canada has a mixed picture as well. Some sectors performing better, some worse, but we have seen some contraction in breadth here. So let's look at the sectors. If we look at the XLF, which is the ETF that houses insurance companies, banks, regional banks, card companies, fintech companies, anything financial, including companies like Berkshire Hathaway, the trend has been solidly higher. So this is obviously the long-term trend. We started into a bull market midway through 2020. Strange, inflation picks up and an inflation asset starts to perform. The XLF has acted very, very well. Even this month, on the pullback we saw to the low point, we've recaptured over a half of what was given up in the last 3-4 days. If we look at a point and figure chart, and I put this up for a reason, what is it that causes us to stop ourselves out of a security? We like to see a change in trend. The point and figure chart is interesting because it shows advancing prices in X's, and when prices pull back, we mark it out in zeros. So over time, in a healthy chart, you should be seeing higher lows, and higher highs. So at this point, really since 2023, when the market bottomed, we've seen a series of higher highs and higher lows, including this most recent pullback, which held at the previous low and very quickly turned around and headed back toward the highs. No technical breakdown, no change in trend, nothing to see here. Now, it doesn't mean all securities behave the same way. Obviously, some stronger and some weaker, and we're looking at it at the company level. But the XLF has continued to rally relative to the rest of the market and continues to perform well, trading above the 200-day moving average. And obviously the breadth data has stayed quite strong. Insurance has been the strongest group. Relative strength basically at new highs, trading above the 200 and the 50-day moving average. And when we look at some of the holdings, there's no surprise, they're behaving quite well. When we look at the point and figure chart for the insurance ETF, KIE, higher high, higher low, higher high, equal low, higher high, higher low, higher high, higher low, higher high, higher low. That's an uptrend. And no lower lows shows why we still have a very significant insurance weight. The financials in Europe, there's been a sharp rally in relative strength, pulled back a little bit at the end of last week and bouncing nicely at the beginning of this week. And this is, again, the beginning of a new bull market, Eurozone financials. When we look at Chinese financials, Chinese relative strength in financials are performing well, and they're also in an uptrend. So really financials around the world strong. When we look at industrials did pull back to the 50-day moving average. They basically are back above it as of today. When we look under the surface, aerospace and defense continues to be exceedingly strong. Look at this push higher in relative strength. Again, trading above all of the rising moving averages, including the 8-day and the 21-day moving average. And basically we closed tonight at a new closing high. Same thing, higher highs and higher lows. So we run hundreds and sometimes thousands of these charts looking for where the strength is. And this is one of the tools that we use to set our stop losses. If I owned the PPA ETF, which is aerospace and defense, my stop loss would be $112, where we broke the lows that we set in September, December, and February. But at this point, they continue to hold in the underlying positions like Howmet, right back to highs, make new relative strength highs. Embraer, nice long-term uptrend. Pulled back a little over the last 4 days, but things don't go straight higher. Siemens is a position that we added recently. It's in power systems and automation products for industrial companies. Obviously, a European company. We bought it by way of an ADR in our equity portfolio. Europe has been quite strong, and we want some exposure outside of North America. And our equity portfolio can have North American positions, but also can certainly look at ADRs in global markets. Waste also continuing to perform well. So everything isn't all perfect in the world of industrials, transportation stocks, which we care about because they can have an indication as to whether products are being delivered or not, has been relatively weak. And so that's something that we take note of, and it's sort of a black mark against the market. We've rallied underneath the long-term moving averages, but this is an area that we obviously are avoiding. So let's talk energy a little bit. Interestingly, Canadian equally weighted large cap energy producers have been slowly making their way higher. We're just off the highs. We've talked a little bit about the fact that the seasonality in February, March, April, and May is strong. But what really has been strong are the natural gas stocks. So ARC Resources, we've talked about as one of the companies that has the largest inventory of drilling targets going forward. You can see, as of yesterday, made a new all-time high. And that's against a pretty tough market. In the US, about the biggest natural gas producer is Expand Energy, used to be Chesapeake. Again, basically at highs. Relative strength, absolutely blasting off. When we look at the long-term chart of Expand, it made a high in 2022, and we're now challenging those highs. And frankly, I think we closed just beyond those highs. Again, that probably starts a new leg higher. So all sectors aren't built the same, and there's developments that take place that can overwhelm sentiment. And certainly we're seeing a lot of strength in this area. We've seen the strength in Cheniere Energy, symbol LNG, because the business they're in is liquefied natural gas movement and infrastructure. And we've seen strength in some of the Canadian gas pipelines. TC Energy is a great example. Again, a nice spike in relative strength. So I've asked Amit Joshi to come on today and talk a little bit about some of the developments that are happening here and why it is that we're bullish natural gas and liquefied natural gas.
Yeah, thanks, Dave. We've talked about LNG in the past with investors and how it relates to our position in Cheniere Energy. We continue to think that LNG is a multi-year investment opportunity as countries globally look for cleaner energy sources and transition off of coal to natural gas. We've seen large demand for Europe and Asia for LNG as well, as energy security has become increasingly important given geopolitical conflict, as well as changes in weather trends. And we had a bit of excitement last week where there were media reports that there was a tanker of liquefied natural gas heading towards Kitimat, BC. This is LNG Canada's LNG facility site. And LNG Canada did come out after and confirm the reports. Essentially, they're importing this liquefied natural gas for testing, cooling, and commissioning purposes of their LNG terminal. And what this ultimately means is that LNG Canada would be then on track to start exporting LNG in mid-2025 and ramping up to nameplate capacity of 2 billion cubic feet a day of LNG over 2025 and into 2026. This would be Canada's first LNG export terminal and a monumental step for Canada in terms of increasing accessing international markets for Canadian natural gas. And maybe just to take a step back, if you can just flip to the next slide, Dave.
Is that the slide you're looking for?
Yeah, that's the one. So in the lower portion there, you see about 14 billion cubic feet that's currently in production for LNG export capacity. This is going to start to trend higher over the next.
No, I lost you on the audio.
Additional. Can you hear me now?
Yeah, gotcha.
Sorry about that. So that'd be an additional 2 billion cubic feet that we'll get from LNG Canada. And as you can see, outside of LNG Canada, we also have numerous other projects that will be coming online, some of those being Canadian, like Woodfibre LNG, as well as Cedar LNG. And ultimately, by the end of this decade, we'll be close to about 27 billion cubic feet a day of LNG capacity that could go to international markets. And this is really important. This is a big step for Canada in terms of our natural gas production, diversifying away from the US market. Currently, Canada produces about 18 billion cubic feet of natural gas a day. A third of that is consumed domestically, and about half of that is sold into the US market. And given what we've seen with the Trump tariff threats and everything else in the headlines, there's been a large dislocation between the benchmark Canadian price, which is AECO, and NYMEX, which is the benchmark US price. There's about a spread of almost $2 there. Historically, that spread's been about $1. So as we see LNG capacity, not only in Canada, but in overall North America increase, that spread should continue to compress. And LNG Canada gearing up and ramping to that 2 billion cubic feet itself should kind of compress that spread by 50 to 80 cents. So looking at this slide on the left hand side there, a change of 50 cents per MCF in the AECO basis is pretty incremental when you look at the cash flow per share sensitivity. As you can see of some of the producers and some of the names that we own, such as ARC and Tourmaline, you're looking at about a 10 to 15% increase in cash flow per share just for that 50-cent ACO basis. And even NYMEX on the right-hand side, as you see that increase as more LNG production comes online and goes into the international markets, a 50-cent change in that NYMEX price is pretty significant overall to the Canadian natural gas producers. So that's kind of the setup that we're really excited about and keeps us bullish on the Canadian natural gas names.
That's great. Thanks so much, Amit. Thanks for jumping on.
No problem at all. Thank you.
Staying on the commodity side, the gold stocks continue to perform really well as gold prices are moving higher. Agnico has really been on the tear since January of 2023. We like it for the dividend. We like it for the dividend growth. We like it for the fact that they are probably operationally the best team in the producers area. But we're also seeing great strength in Alamos, basically today closing at a new high. Wheat and precious metals just a whisper off the highs in Kinross, which traded at a new all-time high today. So really, this group just continues to power along. It continues to be, depending on the portfolio, 10 to 15% of client portfolios. And I keep saying we are not gold bugs, but we think we're in the early days of a bull market that can really benefit the portfolios and protect us sort of in an inflationary world. And the fact is that during the time where gold prices were weak, the capital spending just collapsed. And because capital spending collapsed, the number of new gold finds collapsed. And we know that it takes years from the time you find something to put it into production. So the truth is that there is going to be capacity constraint going forward. And as we have central banks continuing to buy gold as an alternative to treasury bonds, and as we finally have private investors and fund managers starting to build positions, this can go on for quite some time, as it did in the last bull market. So look, there have been almost no flows into gold producers. It's a very unpopular part of the market, and I understand why. People lost money in this group for years. But tactically, when shifts take place, we got to recognize it and put money to work to try to take advantage. And we're doing that. And on the same vein, as we said over the last 2 weeks, watching with interest on the copper producers, the copper producers index is starting to break out as well. So we think that we could get some returns here as well. So look, there's lots of things to worry about, and there's lots of things for us to be careful for. But at the same time, there are second derivatives that cause benefit to certain sectors of the economy. And we are seeing flows into some groups, and we are seeing flows out. And that's why it's not a binary decision when we worry about things like tariff to say, should we be in the market or completely out of the market? We want to be in the parts of the market that are benefiting from the current backdrop. And one of them is this commodity space. And on the point and figure charts, you can see, we are just really starting to break out in the copper producers. So other groups, communications, which has been strong over the last couple of years, including companies like Netflix and Meta, continues to be strong, trading above long-term moving averages, continue to perform well. They are sort of the quasi-tech space. They are beneficiaries from AI, and they continue to perform well. Point and figure charts, very constructive. But tech as a group continues to be weak. A little bounce over the last week, very little pickup by way of relative strength, and no change in the long-term trend. We are below the 200-day moving average for the first time in 500-odd days. And when that has taken place, it tended to mean you're headed for a corrective period. Maybe it's a short-term issue. Maybe it's something longer. I would say, though, that semiconductors and technology in general has been underperforming since June and really not showing any signs of that changing. Nvidia over the last week had the 50-day moving average crossed down over the 200-day moving average, which in general is a negative technical sign. It's a sign that the trend has changed. And of course, Nvidia was a leader in the group for a very long time. and certainly wasn't one that was very popular, us making an exit. But it looks to us like maybe this is over for a little while. The Magnificent Seven, this is an ETF that holds a Magnificent Seven week relative strength, trading basically right at the 200-day moving average. Consumer discretionary looking very similar. Growth stocks in general, this is the IWO ETF, the Russell 2000 Growth Index, trading below the 200-day moving average. And we'll remind you that this is a significant change. Gold relative to the semiconductor index made a turn higher in 2001 and turned down when tech really started to outperform. This is, I think, a fairly significant shift. So last couple of groups. We said over the last couple of weeks that while we had seen some relative performance in defensive assets, if the market at all tried to start finding its footing, it would be unlikely they would continue to lead. And you can see that over the last week, as the market bounced a little, real estate fell, utilities fell, consumer staples fell. So it's still our belief that the defensive sectors are not the places to focus. They are the places that investors go to hide when they have to be in the market, but are looking for something that they might lose less in. So we're targeted. Now, over the week, a number of sectors got better, went back to capital letters. We moved up about 1.7%. The average sector, the percent of stocks and uptrends improved. But the portfolios are more or less the same. Financials continue to be our biggest weight, about the same weight as they were last week. T-bills and short-term Canada bonds are 15%. That really is a holding place to keep money liquid, to keep our options open. Materials are 13% of the portfolios, energy's 13%, both significant overweights to the S&P. Cash is about 9%. Industrials are about equally weighted with the index. But when we get down to the rest of the groups, communication services about 5%, consumer discretionary 2%, healthcare 2%, all significant underweights, technology 1.5%, utilities 1%, staples less than 1%, and actually real estate we're a little bit short in our macro portfolio. So it's a very skewed portfolio. There are very much haves and have-nots. When we look at an index of our various pools, our clients are about break even on the year, and we're pretty happy with that. We're in a pretty defensive position, and over the last few days, the portfolios have been outperforming even on the bounce with cash in the portfolios. From a risk perspective, credit spreads have widened a little bit, so the excess return investors are demanding to take corporate bond risk versus government bond risk has widened a little bit, but really not substantial compared to what happens when there's a problem. Volatility, which had picked up, is back in the middle of the range, so we'll see. But in general, it's not telling us that there's a major problem right now. We're in the process of correcting. And we'll see how long that goes on for. We have dry powder that we can put to work when it makes sense, and we're keeping in mind that there's a lot of news going to come over the next little while. April the 2nd is around the corner. So having flexibility, we think, is a smart idea. Not making is also not losing. It's nice to have some cash on the sidelines. Things get more difficult, we'll get more defensive. That's our history. But as it stands right now, we're very comfortable with the portfolios. We're very happy with the positions that we're holding. And we'll continue to assess this stuff day by day. So with that, let's see if there's any questions. Let's see. Looks like we've only got one. Do we still own Nutrien, and considering the report today that the U.S. will assist in restoring Russia's access to global markets for agricultural and fertilizer exports, would we be a seller today? Yeah, we actually haven't had Nutrien for, I don't know, maybe it's 6 months. Technically, let's see if I can just throw it up on the screen. So you can see that Nutrien's been in a downtrend really since the early part of 2022 when the market rolled over. So, this is not the type of price pattern that we would be a buyer of. Now, it's maybe getting a little bit better. There's some of the fertilizer companies have acted a little bit better recently, but we're not a buyer at this point. And I'm sorry, I haven't seen the report that you mentioned. So it may be that there's more turbulence in front. But when it comes to the materials, we would prefer, to be in copper, which is behaving really, really well. We'd prefer to be in gold. And those would be really our two core holdings. And I think that's all the questions I have for today. Great. Well, listen, I appreciate everybody tuning in. Appreciate the fact that you got choice as to what to do with your Tuesday afternoons. We enjoy doing this. It forces us to really re-examine all of our positions and look at the things that we might be missing to see, are there better areas that we should be focused on? If you got questions that we haven't answered, please reach out. We're very happy to have a conversation on the phone or a Zoom call. And if not, we'll see you again next week. Thanks, folks. Thanks, Amit, for joining us today.